In the Forex markets, sometimes the trends can go quite a ways, and it would be great to be able to capitalize on them and capture as much of that as possible. Hi there, my name is Russ Horn, and I want to show you the way to manage a trade when you're allowing it to run so that you can capture as much of that as you can. Now, we're going to take a look at this from the point of view of a long trade. Now, we'll look at a short trade as well, but right now we're going to start off with the long trade. We're looking to buy. So we get into the trade and we place our initial stop loss. The first thing that we want to be aware of is how the market is likely going to move. When we are in a trending environment, when the market is trending, the technical definition of this is a market that makes progressively higher highs. So every new high that is formed should be higher than its previous high, and progressively higher lows, which means when a market makes a low, the following low should not come down to meet that low. It should get higher and higher and higher. And this is an example of how that works. We've got a low followed by a higher low, followed by a higher low, higher low, higher low, higher low, and so on. And the highs themselves, higher high, higher high, higher high, higher high, higher high, and so on. So the progressively higher stair-step action is what makes this an actual trend. Now, we want to take advantage of this. And the best thing to do is manage our trade using this stair-stepping action. Now, this is a long trade. We're looking for a buy. So let's say we get into the long trade on this candle right here. So our stop loss would go just below that. I'm not going to use this. I'm going to use. So our stop loss would go just below that. So I'm going to mark that off with a red line. So our stop loss goes just below the swing low that happened before the buy trade. All right, so I'm going to remove this line. And now what we're looking for is the market to move in the direction that we want, in the long direction, and give us progressively higher swing lows, because this is where we're going to be placing our stop loss. We want the market to move up, come back down, move up, come back down, move up. And every time it comes back down, that low that is formed should be higher than the previous low. Now, how do we know when is a good time to move our stop loss to that progressively higher low, to that next area, that next zone, something that gets us or locks in more and more profit? Well, the market is going to make a move and then it's going to pull back and then it's going to make a move, but we're not quite sure if that move is written in stone or if it's part of sideways action or whatever the case is. So what we're looking for is that first high that is made before the pullback gets broken by the next high. So if we're looking at this diagram here, see the market moves up, makes a high, comes back down, makes a low, and then moves back up. And once we get a couple of pips, 1, 2, 3, 4, 5 pips above that previous area of resistance, that previous high, once the price gets just above that level, we will move our stop loss from where it was initially to that new swing low. So if I mark this off on the chart, this is our swing high. So we'll just move this out. The price makes this swing high, comes down, and then it gets above that swing high. And that is where we will place our stop loss. We are going to move our stop loss at that time. That is the cue to move our stop. So now the market makes a new swing high and comes down and moves back up again. And once we get just above that new swing high, we're going to move our stop loss to that new level. Market comes up, makes a swing high, comes down, moves back up again. And then once we get a move just above that swing high, the new stop loss is moved to that new level. And that repeats itself over and over and over again until we eventually get stopped out. So using these swing highs as a trigger to move our stop loss and using the swing lows as the placement for our stop loss is how we're going to manage a trade that is trending, a market that is trending, to get the most that we can out of it. Now let's take a look at this on a short trade, sell example. So this is an example of a short trade. Now we've got the market making progressively lower lows and progressively lower highs. Our stop loss is going to go above each new high that is formed when the market moves down below its previous swing low. So let's say we're looking at a short trade here. We've got this trend line. We take a short trade in this neck of the woods. So we are moving a stop loss to its initial point. And then what happens is the price makes a low and then it pops up. And then we're waiting for the market to move just below this swing low. And as soon as it does that, we move our stop loss to that previous or to that very recent swing high. Market goes down, pops back up, makes a new swing high and a swing low. I'm going to mark off that swing low. And when the price gets just below that swing low level, I will move my stop loss to that new lower swing high. And again, price moves down, pops up, gives us a new swing high. And then when the price gets just below that recent swing low, our stop loss moves to just above that recent swing high. And this will happen over and over again. And let's take this one to completion. This one never happens. We don't get a move down below this, so our stop loss would remain here. And eventually we'd be taken out of the trade. So this is how you're going to capitalize on as much of the market move as you can possibly get in a trending market. Progressively lower highs, progressively lower lows, and this is the trick to knowing exactly where and when to move your stop loss.